Okay, we're going to create a cash budget. And like I warned you, I'm not going to, talk through writing everything down. I have the answers here, but I want you to be able to follow me. I just don't want to spend our time doing that part of it. And that's why when I created this update so that we don't do that. But I want you to ask me questions if you understand where I'm getting these numbers. And then I will hand you the actual, what we're going to call the answer sheet. Let me think of where I'm at. Let me show you where I'm at. Yeah, we're in the right place. I'm right here. Thank you. We're right here. Yeah.
Page 12.
Yeah, page 12 is really where I'm at. The workbook does follow along with the slides and gives you additional information. If you've ever had the opportunity to look at it, you'll see that I've tried to put more detail maybe than what we're spending in time to give you some additional resources. Yes, exactly. That's what I think. So the cash budget worksheet is all about cash in, cash out, and the ending cash balance. I mean, just like the cash flow statement, you begin with a certain amount, you have cash coming in, and you have cash coming out, and that is called cash flow. This is kind of like your checkbook. This concept's a little easier because we're going to deal with really where the cash is coming in and where we're spending it. Now, at the top of your cash budget, and turn one more page, I think. Yeah, there's your cash, there's your blank cash budget. That these numbers have been provided here because this is what we've already done. You didn't realize we were working on the cash budget, but we have been. Because there's our what? There's our sales plan. There's our beginning cash balance. That's from the ending cash balance on the balance sheet of year 4. That's what our cash had gotten down to. There's our cost of goods sold. We'll talk about that, where I got that information. And then here's our collection pattern. Remember that? We collected 50% the first month, 5 the second, and 40 the third and fourth. And then I said I'm going to make them keep their 45-day promise. So I'm going to have them collect 50% of the payments from their customer in the first month and 50% in the second month. Cost of goods sold, where did I get that from? Where's cost of goods sold recorded, first of all? You bet. And 58% is where we ended up, isn't it? On page 23 is the actual statements that were from the whole case that now we're going to use again. I'm going to tell you what I did. I've done the work for you, but I want you to understand where I got the numbers. So as you can see, in year 4, the cost of goods sold was 58%. So I'm going to assume, Bob and I, that he can maintain that 58, because remember what was going on. He had eroded 5%. He had added 5% to his cost of goods over the last 4 years. So we're going to assume that he can maintain this 58. Stop the bleeding. Raise a price. That's a lot of what was going on. He was very reluctant to raise any of his pricing, but his cost of goods were going up. The actual price he was paying. So this is how it would be reflected on an income statement. If your cost from your vendors going up, it shows someplace and you don't raise your prices, it increases your cost of goods sold percentage. And I know small business owners have a tough time with this one many times. I've never had someone, after I've talked them into it, I've never had someone come back to me and say, oh, lost all my customers, raise my prices. No. You know, I mean, it is a market. There is a market. That's absolutely true. But you don't always have to be the cheapest to have good customers. There's more to it than that. Hopefully there's a service element to your business. There's a quality element to your business or product. It's not if we were all that price sensitive, what would we do? We'd pay the same price for everything. There would be no competition. It would be Cuba. I mean, it would be a whole different environment. We are in a capitalistic society where it's competitive. So the only thing I have not described to you is that minimum required cash balance. That is just a number that we kind of use when we're doing a cash budget that kind of gives us that's the amount we want to maintain, I would say, in our checking account. It's a comfort check level. Some people say, well, you need 3 months of operating expenses. Or, you need X number of money. It's comfort. If you've been in business, I would go back and average. I would look at how much money is usually sitting in the checking account and how do you feel about it? So is that what you really need to maintain as a cash balance? Okay. So we're going to start projecting and actually preparing our cash budget. Now, this is an existing business, as you all are. So at some point, you start. Well, we're going to start in January. We're going to pretend what? We're going to pretend it's December 31st. It's New Year's Eve. We're working on the cash budget, right? So we're going to pretend that here we are. We have historical sales. So that October, November, December figure I'm showing you is historical. Because at some point we've got to project forward. If this was a new business, we would have no sales, and so we would only get 5% in January, right? Then we would get 15% in January, 5% of January sales, and then you're going to see how it goes. This is how we're going to do it. This is a kind of an easy way to do it. Let's populate it so you can understand where these numbers are coming from. So, I'm saying, you see that $64,000 and you know where that came from. That's 8% of my $800,000 sales plan, right? And I'm saying in January, I'm going to sell. I'm not saying I'm going to collect it, but I'm going to sell $64,000. Then I'm trying to figure out, then, what's my total cash inflow in January? Let's figure it out. Where do these numbers come from? Well, I'm saying $9,600 is what? Is 15% of 64,000. I'm saying 3,770 is 5% of December's sales. I'm saying 25,120 is 40% of November's sales. And then I'm finishing it off with 17,600 is 40% of October's sales, which gives me cash inflow of $56,090, not $64,000, because of my payment pattern research and approach. Make sense? Good. If a different scenario, so for instance, if you all had 10% delayed 30 days or 45 days, you could just do 10% of your sales and move it over. If you collected 90% of it in the same month, that's what I would recommend if you're doing a cash budget. And Diana, you're pretty much getting it all in the same month you sell it. Mm-hmm. So yours is easy. You can just, your sales plan is your cash inflow. Mm-hmm. But most businesses, a lot of times it isn't, if there's any kind of terms extended, because you're going to see the dramatic difference in your sales and the cash flow. As you can see here, if I didn't itemize this, I would think I would have $8,000 more in January than I'm not going to have, because I'm not doing a great job of collecting. And what else is the issue? I have seasonality in my business. Look at December sales compared to October's. That's a vast difference in seasonality. So it affects my timing and when I actually get cash. It also doesn't give me any false illusions when I know what I can expect of when I'm going to get cash, that anything is going to, change dramatically if I'm extending those terms.
Okay, so the numbers there, you said,
Mm-hmm.
the fourth month is November, or October?
Yes.
70,000?
Yes.
Then November?
Yes.
Then December?
Right.
What's
January. That's you. January is you. You're going to get 100% of your January sales in January. They're not. Now they're going to get 5% of their January sales in February. They're going to get 15% of their February sales in February, and then they're going to go backwards. 40% of December's, 40% of November's, which gives them a surprise. Remember, they only sold 48,000 in February. That's all they plan to sell. But if things go according to their plan, they're going to actually collect almost $66,000 in February. So February's not that bad. Why? Because they're riding on the cusp of the last quarter that they're collecting all that money. So knowing when your revenue comes in, when the cash actually comes in, is a huge component of it, not just when you sell it. It affects your cash balance dramatically. You're going to see that. And there's March. And that's all we're going to do. We're going to do 3 months. We would do, I would suggest you doing at least 6 months to determine what your cash looks like. Some people do a year. Okay. So you've got cash in, right? Now we're going to do cash out. One of the first determinations of cash out is what are you going to purchase? And depending upon the type of business is how we're going to determine what this would cost. If you're a retail, wholesaler, or manufacturer, you're going to evaluate this as a cost of goods sold function. If you're a service provider, which we don't have any of those here today really, but I would encourage service providers to use a key variable in that same, it behaves the same as what I'm telling you. Cost of goods sold is just a really, really big variable expense that we typically get some terms on if we're a retailer or a wholesaler. A manufacturer is the most complicated. And really, Diana, you're a manufacturer. If you had a bunch of employees, I would really say you're a manufacturer, but you really are. Ag is manufacturing. You're putting in raw material, you have labor, and you have overhead costs, and that's what you're doing. So, remember what we said. We're going to use 58% of a cost of goods sold. Now, it's going to get a little more complicated than just throwing in 58% of sales as our purchase. Because, think about it this way. When we purchase something, just like when we sell something, is not necessarily when the cash changes hands. When we purchase something, that's not necessarily when the cash changes hands too, right? So, you guys get terms with your vendors? Yeah, okay. So do they. And this is what I made them. I'm going to let them, we're going to show that we're going to purchase it, and then we're going to pay for half of it in 30 days and half of it in 60 days to get that 45-day average of payment. But when am I going to purchase it? Now, I'm an old retailer, so I've been down this road several times, and there's a lot of different, I know there's a lot of different vendors, and there's a lot of different structures, and I realize that, they give you deals, they'll give you, you order it early, we won't make you pay for it until blah, 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 and that's why Excel's a good spreadsheet, because it's very hard to keep track of, when it's due and when you have to pay for it and all that jazz. But in a lot of worlds, we, based upon a sales plan, it's still all going back to that sales plan. If I expect to sell $64,000 in this month, that's based upon an inventory level. Ultimately, if I'm doing buying plans and all that, what I'm saying is I've got to have that inventory here to sell. So I'm purchasing it at least the prior month. That doesn't mean I'm paying for it. That just means I'm purchasing it the prior month at least to have it on the floor or available, let's say I'm a wholesaler, available to sell. Because the expectation is if I don't have it, I can't sell it unless you're a drop shipper, unless you have ability to, you have a warehouse type situation where you have a showroom and then it's all backed up in the warehouse and you don't own it. I mean, there's a lot of different other methodologies, and that's what you have to kind of think through. What's your world and how do you do it? You harvest it. I mean, you're going to you may be purchasing your seeds in what month? You may be purchasing your cost of goods in January based upon your sales plan in May. And that's why you would put the cost of those in the month you purchase them and pay for them, not the month that you're going to harvest them. So that makes you figure out where you are with your cash. Do you guys purchase before seasonal? Do you raise your inventory? Do you ebb and flow your inventory?
Try to.
Yeah, it's hard.
Sometimes we end up stuck when we go into our low season.
Yeah, that's hard.
A lot of forecasting with the brands we carry that they kind of do for us.
Yeah,
The allocations and recommendations they make.
that helps you. They're doing a lot of the work. I mean, really, they're doing a lot of sales plan work for you then. Probably based upon your historical performance, and maybe if they have new models, they probably kind of estimated, maybe they've done some analysis on what they think will happen.
It's helpful for the most part. They all think that they're the only brand in my dealership. And they all expect an increase, especially if they had one last year, expect one this year. But overall, their tools are far better than what I can come up with on my own.
Yeah, because they're putting some effort and money into them too. Those are good. Those are great. You probably learned that maybe how much to cut them by. Yeah. And weather is relative. Have you ever gone to? We did. What year was it? Was it last year? It didn't snow.
It snowed last year, it's not much this year.
I guess it's this year.
Last year we
Because I always think it's fun to go see how many related snow clearance related items there are at the end of a season, or lawnmowers at the end of a season, And sometimes, we've been that customer waiting to see if they're going to cut the prices on those, because we know they don't want to carry them over. Sometimes they do, sometimes they don't, based upon, how much inventory level they want to maintain over the year, because not too many people are going to buy a lawnmower in December, right? I mean, they probably don't even have any on the, well, I don't know. Do they have them on the floor? Do you have them on the floor?
it's like, ooh, you have that deal.
Right.
We're expecting to do 5 in off-season and minimum of 10 in peak season.
Okay, interesting. Okay. Well, anyway, considering when you purchase them, your purchasing plan, as opposed to when you pay for them. So, you're going to use the terms, this particular plan that I've created, we pay them basically $45 because we're going to split the purchase. So let's go back. Here we are. And purchase, remember, is not when I pay for them, but purchase is when I'm making the purchase. So I'm saying in January, now, I'm purchasing for February. So this is a little hard to view. Yeah, it's not going to do it for me. Okay. If you go to February's sales plan, what was February's sales plan? 40, does that say 40?
I think it's 48.
48,000. So 48,000 times 58% should be 27,840. In other words, make sure, I'm sure that, but I want you to understand where these numbers are coming from. Yeah. So what I'm saying here is I'm going to purchase for February sales in January. That's when I'm purchasing it. When am I paying for it? I said I'm going to pay for 50% in 30 days. So there's December's payment of half of that 36, and there's November's half of that 54. I haven't paid for any of the purchases I made in January because I'm not going to pay for it for 30 days and 60 days. So in other words, I'm delaying this. But look, I only bought 27 in January, but I'm paying 45 because I'm paying for all that inventory I purchased previous months. So again, it's hitting my cash flow. Yeah. So this is how I'm going to prepare for that. I'm going to budget for that because I'm going to know, based upon my sales projection, or as close as I can get. It's an art, not a science, of what that looks like. And again, that carries on through March. So that's where those numbers are coming from. Okay, so we're going to predict the rest of the expenses based upon some, and you guys are the lucky ones, you have historical information. If you go back and common size and look at your historical income statements, you would be able to make some considerations, just like I'm going to do right now, to tell you how I determine whether, number one, it was a fixed expense historically, or if it was variable. And I'm going to forecast, I'm going to use some reasonable, thought-provoking assumptions that's going to help me forecast how much my expenses are going to be. So, fixed, we know what that is, or variable or accrued expenses. If I don't have any of the information, I'm going to look to industry standards. And what I mean by industry standards is really what I've given you. If I had no information about this particular type of business, and this happens to be berry except strawberry. Why? What's different about strawberries?
Berries on the ground? I don't know. Berries on the business? Maybe the strawberries on the ground?
I don't know.
They come in to
Maybe, yeah, I don't know. I would say I would know some things. On the average, the cost of goods sold are 32%. Interesting. They spend an average of about 1% on advertising, payroll, depends on how you want to look at it, 28. Rent, about 6%. So that would help me, give me some ideas based upon my sales plan if I had no history. History is going to always be your best resource, however. And then operating plan. So here we are. I have done the work for you. If you will look at, though, if you want to follow me, I'm looking at the profit and loss comparison from page 23. That's going to help me is what I've used to determine what my operating expenses are now going to look like that I'm going to put on my cash budget. Advertising. Now, I've made a determination. I've decided if it's fixed or variable. And then I've even given the amount or the percentage. And it's always a percentage of what? In an income statement, it's always a percentage of revenue or sales. Sales or revenue is 100%. Everything else is as of a percentage of us. So I'm saying advertising is fixed, and, you know, you can argue with me on any of these if you'd like.
I'm sorry, what's the F and B mean?
Fixed or variable? I've made that determination. I mean, hopefully an educated guess determination of that, but it really is my small decision. So I've said it's fixed, and I'm going to spend about $1,050 a month on advertising, which makes it, you know, I'm going to budget that in my cash budget. Bank charges, I considered variable. How did I determine how variable, what the variable percentage was? I looked at the historical common size statements. And when I go back and look, I see bank charges have run, if I did the math, these are pulling it not as a decimal point, but they're running about 0.5% of the total revenue are bank charges. And those are typically what? Those are credit card charges usually, right? Some people lump those in there a lot, and those can get off a lot higher than 0.5%. Do you take credit cards? Do you have the Square or anything?
I took a credit card once, an $8 credit card, and it cost me over $50 in bank fees. I closed that account yesterday, so I don't want it this year. We're gonna go with a middleman that fees are lower. Because I didn't know if you got a paper statement that they charge you like $1 million for it. I guess that's it. How did it cost you $50 for?
Well, probably the fee. They probably charged her a setup fee and
Right. Well, I know my husband paid about $30 a month for his working account, and then he got rid of it for something called, I'm blanking out on it. It begins with an S. It's not Square.
it's not Square.
No, it's something else. Solution.
There's a lot of options out there. Now, you guys take bank cards, I'm going to assume. So do you know what your rate is, how much you're paying?
Works out very close to 2%.
There you go. But this is variable, and you could do that. You could, you know, a couple of methodologies you can think through. You could see what it was as a percent of your total, but you could also figure out if you knew what percent of your sales were charges and knew it as 2%. I mean, it's totally up to you. Just thinking through this, it's running 0.5 of all my sales. All my sales aren't credit cards. Obviously, remember in this particular business, very, very few of them are. That's why it's so low. Because why? Because they're extending their own terms. And that's what they were doing. Part of the reason they were doing that, just FYI, was because they wanted to avoid the credit card charges. Unfortunately, think about what that also cost them. Because credit card charges post pretty quickly, right? Remember, they're at 62 days. Yeah, so they lost about 62 days because they didn't want to pay the 3%. So we could do the math and see if that was a good plan. It probably was not.
It was called Stripe.
Stripe.
2.9% plus 30 cents per transaction. And that's it.
That's not bad,
And I
because that's small volume, and they're going to charge you a lot more.
Stripe is the way to bypass a traditional business checking account, because a lot of e-commerce, a lot of e-commerce businesses are having all their payments go through Stripe. And I know this because on my bank statement, when he gets paid, it comes through as Stripe, 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 Stripe. The thing I don't like about it is I don't know who the client is. It all looks the same. It all looks different. Now he will know, but I don't know.
Very
And
interesting.
they do global banking. I think this is really going to grow this way because they do.
Well, you know, the banking industry obviously is changing, you know. You can really get nitpicked with fees. I've seen it. Oh, man, have I seen it.
Other
Ugh.
countries want a U.S. bank account so they can get U.S. dollars, and that's one of the biggest challenges. Well, now you can start an LLC in the United States and never physically be here. Silicon Bank in
Yes, you can. You're absolutely, you can do that. They just had a huge NPR report on all that. It was very interesting. Yes. In fact, in Delaware, they don't even ask you any questions. It's just crazy. Yeah. Okay, so bank charges, 0.5. Insurance, variable, it's been running 1%. I know that because I've looked at my analysis. And I know that because remember, variable as a percent of revenue, remember what revenue was doing? Revenue was going crazy. And my insurance was consistently at 1%. In other words, it was going up too, though. In proportion, and that by true definition, that's what variable means. It's going up in proportion to revenue. Officer salary, that's the officer, that's the owner. It's fixed. Payroll taxes, it says something strange there. It says fixed and variable. And what that means by that is part of my payroll is fixed, isn't it? Part of my payroll I've identified as variable. Wages. This is a retailer, and he was truly able to schedule his payroll as variable. So in February, when sales were really low, he really cut his payroll. That's because he had part-time employees, and he could do that. Not everyone can do that.
What about sales teams or other departments that are commissioned? That'd be another example of variable.
Absolutely. Great example.
We've got a lot of that.
Great example. Maybe, is part of it fixed? Is it a draw situation?
There's not a draw.
Not a draw.
Part of it's fixed.
But part of it is fixed. Okay. Got it.
Base plus.
Base plus. Okay, but not a draw, so they don't claw back.
Correct.
Okay.
They don't have early money.
Yep. Worked on those. Those are ugly. The hole gets deep sometimes, and then the employees get so discouraged. Yeah. Yes, so yours would be your payroll would be part fixed, part variable. And that would really help you to get your head around payroll, because your payroll goes up dramatically in good months, too. Yeah.
Our service department is beginning to venture into full commission.
Really? Your service department?
Well, everybody, up until today, 4 years ago, they all drew an hourly wage.
Okay.
We migrated them
Yeah.
gradually.
Yeah. Because it's a big deal.
At about a 50% base plus 50% commission. But my most recent hire, straight commission.
Wow.
He gets paid $20 for every billable hour he produces.
Wow.
That's kind of what
And as long as he's paying him minimum wage, this is not an HR class, but as long as he's paying him minimum wage, he's fine.
$20 for every billable hour.
Mm-hmm.
Okay, so the billable hours, I got it.
Yeah, but how much do you charge an hour?
$78.
$78. Wow. It's like a car, right?
We just got access to HR Simple in our network, which is a wonderful
Mm-hmm.
blog and rules from the Missouri Chamber of Employees, so it's all free, so if you want any of that.
Yeah.
I had one client who said she needed help motivating employees, so I went in and there's a blog on how to motivate employees.
Really? With money.
Yeah.
Yeah, that's tough. Well, because not all employees are the same. And not all of us are motivated by the same things. I mean,
She tried different incentive plans, and one employee didn't care.
but they wanted something else, maybe.
Maybe, yeah.
I mean, that's true. I mean, they tell us, psychologists tell us that what our number one thing that we really want from a job, what is it? That's right. The man knows. Yes, recognition. We just want recognition for a job well done. Number one. We wanted that more than money, which sounds crazy to me, but no, I'm just kidding. But that is absolutely true. We just want to be valued. We just want to be recognized for, doing what we do. Yeah. Now, I think that is true for as long as we're not just grossly underpaid. I mean, I think that's a caveat. I mean, I'd like to be recognized, but, if I'm making minimum wage, I probably, I'm going to be pretty motivated by money too, probably. But that's what they tell us. We just want our name on the board, right? We just want to know that someone. I've been teasing because I'm retiring, and I've gotten a lot of wonderful notes. And I said, when I'm feeling really down on myself, I have saved all of them. I'm going to go back and read them, and say, I'm going to go back and read them and think, oh, I did make a difference, in someone's life anyway. Okay, so rent, fixed, that's easy, right? Supplies, repairs and maintenance, variable. Does that make sense to you? That repairs and maintenance and supplies would be variable? In a lot of businesses, yes, not in all. That's why you have to go back and analyze, common size your statements and see how your expenses are behaving. If there's no correlation, if it's all over the place, it's probably not variable. Either that or we have a little bit of garbage in, garbage out sometimes, depending upon. Sometimes you got to drill down and see what was expensed in there and why it looks funny. Telephone utilities, fixed, that makes sense. Travel and entertainment, makes sense. Wages, makes sense in lots of cases. And then a website. And then we have our principal loan payment and our interest payments are typically also fixed, right? Absolutely. Because of the way I've done this cash budget, there are other things that we may want to put on it that we're not going to deal with today. The owner wants to take out $5,000 in July to pay for the new boat. I don't know. Maybe you're making tax deposits and you need a plan for that. Like in a particular month, you're going to buy a new capital piece of equipment. You're going to buy something that you're going to capitalize. So there should be blanks always on a budget so that you can put in things that you're thinking about doing. So there's our answers. And all this is, remember, these are percentages of the sales plan. It all starts with the sales plan. So a bad sales plan is rough. And that's why you're lucky that you feel pretty good about your sales plans that your vendors are giving you. That's valuable to you. It gives you a great starting point, and then maybe you want to, just tell them that, you're not my only vendor. Nicely, right? Yeah. Okay. So then the variable, those are all just multiplied out. The fixed, you can see, the fixed are just repeated as a fixed expense for that month. So there we are. In January, we're estimating we're going to have $24,642 worth of expenses. In February, look, how consistent is that? That's really weird, right? There must not be very much difference in the sales plan, right? And there's not, because there is a lot of fixed expenses. What's variable? Look at bank charges. You can see it's varying because your sales plan is varying. Look at wages. Wages are varying because that's all based upon our sales plan. But if you're not going to vary it, don't do that. You guys, well, yours is your commission will always be a variable, but your fixed, you don't call it a draw. What do you call it? Because it's not a draw. It's
Fixed,
you
salaries,
you just have a salary that they're going to make no matter what.
correct? And then in service, we have an hourly wage.
Okay. And then that's cool. I mean, I can visualize how you can figure that out. Maybe you want to do it even by department, kind of to get a better feel, for what that looks like. Yeah, you could. Okay. We're running down to the bottom now of the cash budget worksheet. So here's what we've got going. We remember, if you'll recall, we had $45,000 worth of payments for cost of goods sold. Now we have $24,000 worth of expenses. So our total cash outflows in January are budgeted at $69,642. February, 53,362, and in March, 57,122. That's cash out, but we've got some cash coming in. And here's the bottom of that. So here we go. So, oh, that's ugly, right? Our net cash flow in January is really a negative $13,332. Let me pass out the finished cash budget that we're really working on. And you'll be able to see that. So these have been, so what I'm showing you now is this number. That net cash flow. This number. Ugly. But real. This number. Net cash flow. However, we began the month with 4642, right? So based upon this particular cash forecast, we would have a negative cash balance. But remember, it's December 31st. This isn't real yet. It'll be real tomorrow. But we're just estimating at this point, so we can react. That minimum balance thing is just, that's just the comfort. That's just telling me if I really want to maintain, $4,500 in the checking account, then I really am going to be $13,000 short in January, not 8. Okay? But it's a planning tool. I'd much rather know this before January, right, than at the end of January when I am short $8,900 in real cash. February, it gets better, which is weird, right? Because February's our bad little sales month, but it's better. Where our net cash flow is a positive $12,000. You remember why, though? We were collecting from those big months. And our revenue and our expenses weren't high because it was that short month. So all of our variable costs were smaller. So, it was a good month. Yay, right? So if we had enough cash on hand to get us through, we almost broke even from a cash point in the 2 months. However, we began the month with a negative number based upon our forecast, which gave us an ending cash balance. We still have a positive cash balance. That $4,500 is just a arbitrary comfort number. Then in March, what happens? Oh, things are better. In March, my net cash flow was $10,000. I began with $3,400. My ending cash balance is $14,000. So the moral of the story would be what? I need a minimum of, if I dismiss the $4,500, I need a minimum of an additional $8,900 to get me through. Those are real cash numbers. I only have $4,600 sitting in my checking account. It's what I've estimated. Okay, makes sense? That's why we cash budget. Seasonality along with variable expenses and when we collect and when we pay greatly influences our cash. Okay. So now we're going to use this cash budget you have in front of us. That's the whole purpose of creating it, right? We've created it. Maybe we don't like some of the months. We don't like what it looks like, but now we're going to use it to make some decisions. We forecasted it. We kind of know where we're at, right? And we can see that if we just look at the ending cash balance amount, we've got a whole year on this one. At the end of the year, we still have some cash. So basically, beside that first month, what have we done? We have cash flowed that sales increase, is what I'm telling you. We have. We have continued our cost of goods, so we have replaced all the inventory we've sold through our purchases, and we've paid all of our bills as far as we know at this point. Now let's look at some additional considerations that would affect our cash budget. First one. First decision point. Remember that short-term money that we were borrowing. If you remember from last week a little bit, we were borrowing short-term money. Why? Remember what was going on? Well, we were having huge growth, and it was eating money. And we were still playing down long-term, so we needed short-term money. We were not cash flowing all that growth. So we borrowed short-term, and when you borrow short-term, you know what happens. Your loan officer calls, and he's called to remind you that $2,000 of the additional note that he loaned you last fall is due. You negotiate to pay $2,000 in March, and the remaining balance he's going to refinance for 12 more months. Can you do this? What will it do to your cash budget? So what are we going to do? We're going to pay $2,000 in March. Looking at our cash budget, do we have $2,000 in March to pay it? We do. In March, we have $14,000 remaining cash. So can we do it? Yeah. Is it going to affect us in December? Yeah. But can we do it? We probably can. And we've negotiated the additional $2,000 he's going to refinance. Common problem. That's why lines of credit are not always the best choice for growth purchases. We want a new sign. We always want something new. I do too. They'd like to install a new scrolling LED sign in front of the business. They'd like to have it installed in January. Payment would be due in 60 days. Cost is $6,000. Can they cash flow it? Cost $6,000. They want to install it in January. Would